All right, this is Ubaid on behalf of V Electronics, and in this video, we'll be talking about bank regulation. All right, so when it comes to central bank, we did mention in the last video that one of the responsibilities of the central bank is to regulate banks, commercial banks, and make sure they're financially stable. Okay, now, when they do carry out this task, what they basically do, okay, is protect individual savings and prevent a bank run. Okay, and a bank run is basically a scenario where clients of the bank they run to the bank to withdraw their money because they think the bank will become bankrupt in the future. Okay, sometime in the near future. And we'll talk about bank run in a bit. Okay, so apart from protecting individual savings, you also have reserve requirements that need to be met, and the central bank makes sure that these reserve requirements are met. Okay, so the other responsibility when it comes to financial stability of commercial banks is to make sure that they meet their required reserves. And we know the required reserves are 10% of total deposits in most cases. So make sure reserve requirements, make sure reserve requirements are met. All right, now apart from making sure that the reserve requirements are met, okay, there's also restrictions on the type of investments banks are allowed to make. And we're talking about commercial banks over here. So put restrictions, maintain restrictions on the type of investments, on the type of investments banks are allowed to make. And we're talking about commercial banks over here. All right, now all this has to do with liquidity. Okay, so when it comes to banks' liquidity, okay, the central bank makes sure that the banks have a positive net worth. They make sure that they have enough assets to meet their liability obligations. Okay, so this has to do with liquidity. And part of the responsibility of the central bank is to make sure that commercial banks are liquid enough to pay off their liabilities, make sure they have enough assets to pay off their liabilities. Okay, make sure they have enough liquid assets. Okay, to pay off their liabilities. All right, so if the depositor, for example, wants to withdraw his or her money from the bank, a deposit is sort of like a liability, as a result of which the bank should have enough assets. And we talk about assets, we talk about reserves, required reserves, as well as other reserves, access reserves. Okay, so make sure banks have enough assets, make sure Uh, their loans are being paid on time. Okay, the interest is being received, so on and so forth. All right, so that has to do with liquidity. Now, apart from liquidity, okay, the central bank, they also make sure banks are solvent. So solvency. All right. So make sure that the banks are solvent. Okay. And in general, they supervise the banks to make sure they're financially healthy. Okay. So financially healthy. Okay. Apart from the investments that people make in the bank, apart from the products that the bank offer to investors as well as clients. Okay. Such as, okay, line of credit, okay, personal loan, auto loan, okay, mortgage loan, so on and so forth. This would be products that they offer to their clients, and they may also offer mutual funds, okay, so on and so forth to their investors. Okay, so when it comes to investments and products, they want to make sure, okay, these investments and products are offered in such a way that the bank stays liquid enough in case they need to meet their liability obligations, in case the clients who invest in the banks, the clients who put deposits in the bank, whether in the checking or savings account, okay, they do have enough money to pay off their clients, make sure the clients are able to withdraw their money whenever they need to. All right, so make sure they're financially sound and stable. So this is financially sound and stable. All right. Now, apart from this, okay, um, as I mentioned earlier, one of the responsibilities of the central bank has to make sure that the banks do not go bankrupt. Okay, make sure that they can prevent a bank run. Okay, and one way to prevent a bank run is through deposit insurance. That's the key word over here. This is deposit insurance. Okay, so the Congress introduced two programs. They came up with two programs. One of them was deposit insurance. And this deposit insurance program had to do with insuring the deposits of clients in the bank. So if the bank was to become bankrupt in the future, okay, the deposit insurance, just like any other insurance product, would make sure that the banks are able to pay off their clients. Okay, the clients are able to withdraw their money and that the clients do not lose their deposits. Okay, so make sure that the clients are protected. Make sure the clients and their deposits are protected. All right, so that has to do with deposit insurance. And the second part to this has to do with lender of last resort. Okay, so this is lender of last resort. Now, when it comes to lender of last resort, okay, the lender of last resort has to do with the deposit insurance. Okay, however, in this case, what ends up happening is to maintain the liquidity of the banks to make sure the banks don't become insolvent. Okay, the central banks, they provide funds for emergency. Okay, so in case the commercial banks are running low when it comes to their required reserves, if they're running low on their required reserves, the central banks will go ahead and provide the funds that are required. Okay, to make sure that these banks are able to pay off their clients, make sure the banks are financially healthy. Okay, so this is lender of last resort, and this has to do with emergency loans or emergency funds. emergency funds to reinforce deposit insurance, to reinforce deposit insurance. Okay, and make sure that the banks, the commercial banks, are financially sound and stable. Okay, so financially sound and stable. All right, so apart from that, okay, this is Ubaid on behalf of B Electronics. You have yourself a great day.